So, Fed Chair Jerome Powell laid out the Federal Reserve's position regarding inflation at their annual conference in Jackson Hole, Wyoming. What did he say? Let's talk about it in today's video. Hi, I'm Mike Reiner. I'm a lifelong Democratic activist who's concerned about the direction our country is taking. I'm also a lawyer and an academic, and I'm here to help you stand up to the BS of the MAGA crowd. So at their annual conference in Jackson Hole, Wyoming, the Federal Reserve Chair laid out how the Fed is viewing inflation. The speech was highly anticipated and resulted in a big drop in the stock market, largely because traders realized that, well, with higher interest rates, that's going to mean better returns for bonds than for stocks. So that's a whole separate issue. But why don't we check out what the Fed said and see what's in store for us in the inflation crisis that we've been dealing with. Check it out.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Now, here I have to disagree with the Fed chair. The problem with price stability is that it's kind of a balancing act here. You can either have higher inflation or higher wage growth and lower unemployment. You kind of can't have both. So what the Fed chair is essentially saying here is that he's putting greater value on achieving price stability, in other words, reducing inflation, than he is on protecting the job market. That's going to be relevant to our discussion as we go forward here. Let's keep watching.
The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability.
Now, I have to disagree with the Fed chair here as well. We have to remember the biggest people who are hurt by inflation are actually the banks. And they're, by the way, the constituency of the Federal Reserve. It's not by accident it's called the Federal Reserve Bank, not the Federal Reserve representative of the citizens. That's supposedly what Congress is supposed to do. But look at it this way. If a bank has issued a loan charging 4% interest rate, which is not uncommon for mortgages, looking back a little bit, and the inflation rate is at 6%, well, that means that essentially the bank is actually losing 2% on its investments. On the other hand, though, if the bank issues a loan at 4% and the inflation rate is 2%, then that means that the bank is making 2% on that loan. So banks are really the ones who, more than anybody, are upset about high inflation. Let's continue watching this video, though.
Will take some time and requires using our tools forcefully to bring demand and supply into better balance.
Okay, this is where things get interesting, and it kind of comes back to what I was saying earlier about the unemployment rate. The employment market has been going bonkers lately. People are getting jobs. There literally are not enough people to fill all the jobs that employers are demanding right now, and as a result, wages have been going up quite a bit. Now, there are two things that have been driving this issue of inflation. One is on the supply side, and that has to do with things like the supply chains being all messed up, and the war in Ukraine, and the price of oil going up. So those are supply side issues, where supply isn't able to meet demand unless it's at a higher price. The demand side issue is created by the fact that coming out of this pandemic, people had a lot of savings, at least in part because of the fact that the government had sent out checks to everybody. So as a result of the fact that we had this money on hand, we're able to spend it. Well, again, thinking back to the old supply and demand curve from Economics 101, if you have higher demand and lower supply, then the prices are going to go up. And that's basically what's happening. Now, the problem with the Fed is that they can address the demand side. How do they do that? They do that by raising interest rates. When they raise interest rates, they drive down demand because they make it more expensive to borrow money. So the most immediate example of where you can see that is in the mortgage market, where people want to borrow money to buy houses. Suddenly it's gotten a lot more expensive to borrow money to buy a house. Mortgage interest rates have gone way up, and that's because of the increases in the interest rate by the Fed. What does that mean? Well, that means that fewer people are buying houses. That means that there are fewer new appliances being purchased, less wood, less nails, less other materials. There's less demand for the workers who are building the houses. So these people have less money to spend. And as a result of this decrease in demand, then you're able to have prices come down. And that's basically what the Fed is doing. But you have to understand, this is not without cost. And that is what the Fed chair is warning us about here. He's saying that the Fed is committed to reducing inflation, but what it's going to mean is it's probably going to mean higher unemployment. Let's continue watching this video.
While the lower inflation readings for July are certainly welcome,
Okay, now that's important to note that there are a lot of prognosticators who've argued that we've probably reached the peak of our inflation at this point, because actually last month, inflation went down a little bit. That's positive, right? But let's just see what the Fed chair says here.
Single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
So in other words, what the Fed chair is saying is that we're going to continue to increase interest rates to try to decrease demand. And the way that we'll decrease demand is essentially by driving up unemployment until they start to see a whole series of months where prices are going down. It's not enough that there just be 1 month, but that there be a whole series of months. Let's keep watching.
So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. Of course,
so that's what they're talking about, reducing the inflation rate to 2%. Now, you have to understand, back at the end of the crisis in the 1980s, when Paul Volcker famously was able to drive down inflation from its heights from the late 1970s and early 80s, he drove it down to 4%. Now, somehow over the past few years, the Fed has become obsessed with this 2% figure. And the reality is, it might take a lot of pain to actually get to 2%, a lot more pain than it would take us to get to 4%. So that's an important signal that the Fed chair is sending here.
Inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
Okay, now this is the important point that the Fed chair is saying here, and it's something that can't be ignored when we talk about inflation or economics at all, which is the psychological impact of these issues. And what the chair is talking about is what are called inflation expectations. And the fear is that you start to get in what's called the wage price spiral. And that's what we had in the late 1970s and early 1980s, when it took a severe recession to get inflation under control. And how that works is that people start to think, oh my gosh, inflation keeps going up. It keeps making my raises worth less and less money, so I need to demand more money for my raises. And that's a sentiment I can understand, frankly. I just got a notice from my employer that my wages went up, get this, 2%, which when you're looking at inflation of 8% or more, that means I'm actually losing money relative to what I was earning last year. So what's my response going to be to that? Well, next time I go in and bargain with my employer, I'm going to say, hey, wait a minute, I want to have you make a big enough increase in my wages that it covers the amount of money that I lost as a result of inflation. But when that happens, then the employers have to pass on that increased cost to consumers in the form of, you guessed it, more inflation. And as a result of that, then the employees start asking for higher wages again, and it ends up going up and up and up. That's the wage price spiral. And that's what Jerome Powell and the Fed are seeking to avoid. Let's keep watching here.
History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. Our aim is...
So this is actually where the Fed chair has a good point, I think. And what it has to do with is the fact that acting now and getting inflation under control now, which is what the Fed is doing quite aggressively, by the way, is going to create much less unemployment and a much less severe recession than would be caused if we waited. So I actually think it's encouraging that the Fed is saying, look, we're going to deal with this, we're going to get this under control, because the bottom line is they're going to get inflation under control. The question is, how much pain is it going to cause to employees and the rest of the public? And by moving quickly right now, the hope is the pain will be relatively minimal. There will be pain, but the hope is it will be minimized. Let's keep watching.
to avoid that outcome by acting with resolve now. So these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
Okay, so the amazing thing about that talk, actually, is that Powell was very direct and very specific about what his intentions were. There's this idea of Fed speak that former Fed Chair Alan Greenspan was famous for. And what that is basically saying a bunch of words that mean nothing. So the markets don't know what you're going to do. And the Fed likes that because it kind of gives them some room to maneuver. If the markets don't believe that a certain thing is going to happen, then they won't be disappointed when you suddenly change your strategy based upon a change in the circumstances. Powell, however, has made it quite clear that he is going to continue to increase interest rates until we get inflation down to 2%. That's a very strong statement. And it's why, by the way, again, the markets responded. Now, people say, oh, the markets responded negatively because the stock market went down. But what they forget is that that's basically people going from the stock market to the bond market, where higher interest rates are going to bring a higher return. That doesn't necessarily mean something bad about the economy. Now, there might be some specific businesses that are impacted, say home building businesses, for example, by the increase in interest rates. But in general, the reaction of the stock market has more to do with what's a better investment in the short run than what is going to be impacted by these interest rates in the long run. Overall, I think that Powell is doing a pretty good job dealing with a difficult circumstance. The Fed, along with pretty much everybody else, myself included, had underestimated the impact of inflation early on, and they've really been working hard to get it under control at this point. And it appears that they are doing that, as we've seen from the positive figures from the most recent inflation readings. Well, if you want to see another video where I actually explain how inflation works, check this out over here. I go in some detail if you really want to get into the nitty-gritty of it. I'll see you then. In the meantime, let's hope for continued progress. Thank you.